Time for our GMS Focus. The Bank of Korea kept its key interest rate at 3.5%, suspending steep rate hikes for the first time since August of 2021. But BOK Governor Lee Chang-yong said that this doesn't imply the end of monetary tightening cycle, citing, of course, lingering uncertainties. For more on the central bank's latest rate decision, we connect with Professor Yang Jun-sok at the Catholic University of Korea. Good morning, Professor Yang.
Good morning.
Thank you very much for joining us. So let's begin with the Bank of Korea's chief, what he has said. He said that Korea is seeing signs of disinflation. And so policy members agreed to monitor the situation for the time being before raising the rates further. Metaphorically speaking, in the haziness, it makes sense to maybe take a beat before further rate hikes. Can you perhaps explain first what's behind the BOK's decision to freeze the rate this time around?
Okay, well, let's take a look at what the Bank of Korea said about the rate freeze. Governor Lee Chang-yong has said that he's waiting to see how the effect of the previous rate hikes are going to work out. And he does have a point in that this is the fastest and largest rate increase by Bank of Korea since Bank of Korea switched to interest rate targeting in the late 1990s. And because they worked on a different standard, it's not directly comparable, but this current period of interest rate increase just may be the fastest and highest in Korean financial history. Since August 2021, the Bank of Korea raised the rate 10 times for a total of 3 full percentage points before halting last week. So there is good reason to see that, let's see how that rate rise affects the economy. Bank of Korea, Lee Chang-yong specifically said that the rate freeze was not because of concerns about slowdown or recession, and Bank of Korea does not have a particular exchange rate in mind. So the rise or fall in exchange rates, one against U.S. dollar or other currencies, is not the primary goal of monetary policy. And because inflation is still fairly high, much higher than the Bank of Korea's goal of 2%. They will be continuing to raise interest rates, but they're just holding off for now. So this is what the Bank of Korea says. The only problem is I'm not quite sure this is what the market or observers really believe. I think the market and the analysts do believe that Bank of Korea and the government is very much worried about economic slowdown. So the rate freeze was because of the economic slowdown. The fourth quarter growth rate was minus 0.4%. Exports are falling. We had hoped that the opening of the Chinese market would have a larger effect on exports, but that's not taking place right now. So that trade deficit is increasing. Housing prices are falling perhaps too fast, and market transactions in housing market has been frozen because everybody's concerned about higher interest rates, and they're probably not going to start buying again until there's at least some signals that the interest rate will stop rising. And then there's more complaints about interest rates and interest rate burden by the regular Korean people, and as well as the continual high inflation. So Bank of Korea is stuck in a bit of a hard place. They want to keep raising the rates because of the high inflation, but because of the weak Korean economy, they really cannot afford to raise the rates again and again. So I think the market figures that the rate freeze this time was substantially due because of weaker economy, and that makes what the Bank of Korea will do at the next meeting, which is in April, very interesting. Will they freeze the rates again because of the weak economy, or will they raise the rates if the inflation continues to rise? And the big wild card here is what the United States will do, and that concerns the exchange rates. Because Korea does not want the interest rate gap between the United States and Korea to grow too high. The United States right now has a higher interest rate, and the gap is right now 1.25 percentage points. The wider this gap is, the more likelihood that we are going to perhaps we're going to see a exchange rate instability like we saw on last autumn, when we had a very large and sudden changes in exchange rates. Nobody really wants that, and the way to try to keep the exchange rate stable is to keep that rate gap between U.S. and Korea relatively narrow, but we can't do that if the U.S. keeps on raising the rates, because then Korea will have to match the U.S. rates one by one, and that Korean economy, I think, is too weak to withstand that. Now, there is some problems right now in the currency market. As you know, the Korean won has hit over 13.21 per dollar, just change of 18 won yesterday. That's a huge change, and that is widely attributed because there's a realization now that perhaps the United States will raise the rates by 50 basis points when they meet in March, when the expectation was that they would raise the rates only by 25 basis points, 0.25 percentage points previously. So if the United States raises the rates more and longer than what they had indicated just a few weeks ago, then Korea may have no choice but to follow, and that is causing some problems in the currency market, and also some problems with what BOK is going to do for the next couple of months.
The BOK also lowered consumer price inflation for this year to 3.5%. That's slightly lower than its previous projection of 3.6%, of course, amid signs of slowing inflation. But 5 of the policy board members left the door actually wide open for further rate hikes to as high as 3.75%. So what does this all indicate, Professor Yang?
Well, primarily inflation is still high, and they're not sure if inflation will fall significantly within a medium term over time. When I say medium term, it's within this year.
Right.
And it also indicates, because of the exchange rates, do they believe that United States will keep on raising the rates? And the answer seems to be yes. United States was giving signals that they will raise the interest rates perhaps twice this year by baby steps of 25 basis points. They would raise it by the first half of the year, and then for the second half of the year, they would not raise the rates anymore, though they would also not lower the rates. But because the United States had an incredibly good labor market figures in December, and also fairly good numbers in January. And then the latest personal consumption expenditure inflation figures, they seem to show that inflation is actually re-accelerating. The inflation over the month of January alone was 0.6%. And that was higher than where it was in December, which was 0.2%. So just by those figures, it does seem like inflation is re-accelerating, and that raises the possibility that the Fed will raise the rates by 50 basis points during their next meeting, and the United States will keep on raising the rates for the second half of the year. And that is basically what's causing the turmoil in the currency markets. And I think the Bank of Korea Monetary Policy committee members do see that United States economy is still strong. Inflation in Korea is still strong. And this current interest rate by itself is not enough to deal with those two problems.
So then what about the major drivers of inflation? Because it seems like food and energy prices have mostly fallen compared to the month of January. So then what's driving inflation primarily in South Korea?
Well, in South Korea, it's a bit different from the United States.
Right.
In the United States, it's being driven by higher prices for services, which is driven by higher wages. And that's partially because the United States right now has a very strong economy with strong demand and lack of labor availability. Korea, even though Korea right now has very low unemployment rate at 3.6%, a lot of the Korean jobs are basically part-time jobs. So, and as I mentioned, the last quarter's growth rate was minus 0.4%. There's a good possibility that Korea's first quarter growth will be minus growth as well. So, what Korea, the inflation is driven more by still rising prices in manufacturing than in services. And if you look at the figures, the highest component, the component with the highest inflation figures are actually utilities, electricity and gas. And that's because those prices are government controlled. They should have been raised last year, but the government, because they didn't want to pile on additional inflation in addition to the high inflation that we already saw last year, they delayed raising the prices, and that's coming back to haunt us right now. If we look at year-to-year changes in utility prices, it's more than 20% right now, and that's a major contributor to current high inflation figures, which is divorced from the underlying energy prices because, again, the government had delayed raising the energy prices, utility prices last year.
So it eventually had to give. Professor Yang, unfortunately, due to time constraints, this might have to be our last question. The BOK's board members appear to be divided on their projections of rate peaks. Some predict rates to climb higher than 3.7%, while others say it should peak at the current 3.5%. Based on your expertise, what is your projection, and when will we be able to start discussing a rate cut?
Okay, I believe the rate peak will be higher than expected. It'll be the rate will hit 3.75 this year, definitely, and perhaps 4% within 2023. And that's because of the reasons I said earlier about the U.S. continuing the rate increases and inflation not falling down. When will the rates start? When will the interest rates start to fall? That I think depends a lot on the United States. Unless Korea faces a major recession, and I hope that doesn't happen. Unless Korea faces a major recession, I think the Bank of Korea has no choice but to follow the trends set by the United States. And the United States Fed has, they already indicated they will not lower the interest rate this year, but the strong labor market figures and continually high inflation figures makes it very likely that they will continue to raise the rates throughout the year, and Korea will, I think, have to follow. So either way you look at it, it's bad news. Interest rate will probably continue to rise following the United States. Or if the interest rate does fall for Korea, that's because Korea is going to be involved in a major recession or a serious slowdown. And either way, it's not good news.
All right, Professor Yang, because you kept your answer so concise, I do think we can squeeze in our last question, thank goodness, because I think this is just as important. The Korean won weakened against the U.S. dollar and concerns over the U.S. Fed's additional rate hikes. While some predict the Korea-U.S. rate gap to widen to as much as 1.75%, how do you gauge the impact of BOK's rate freeze on the $1 exchange rate?
Okay, well, the wider the rate gap, the higher the possibility that we will have a very unstable exchange rates. As long as the gap exists, there will be pressure for won to depreciate And I think that's what we're seeing right now. I think people are expecting that interest rate gap to be larger. So the market exchange rate is reflecting that, but it is also reflecting that perhaps faster than expected, and also perhaps it's overcompensating like it did last autumn. But still, having the price of the won change by more than 18 won per dollar in one day, I think is a very serious signal. Perhaps Bank of Korea should have raised the rates by 25 basis points last week, but the problem was that the signals that said that BOK should raise the rates perhaps came too late. The statistics for the strong U.S. labor market and the rising inflation didn't come until maybe about a week before the Bank of Korea Monetary Policy Committee made its decision. So it's understandable, perhaps, that they missed the chance to raise the rates. But still, because they missed that chance, I think we are going to see a faster depreciation of the won and much more instability, perhaps faster than warranted depreciation.
Thank you very much, Professor Yang, for today's insights. We'll speak to you again next week.
Thank you.
If you're listening to our program using the podcast service, just a reminder that we do go live Monday through Friday, 7 a.m. Korea Standard Time. So tune in and help us make the show more informative by giving us your input. See you bright and early on Good Morning Seoul.